Markets closing today a little change. The Dow staging a late session comeback and closing at a new record high. Joining us now is Ron Temple, Lazard Chief Market Strategist. Ron, it's good to see you. So as Julie was just saying there, a little change today, Ron, but positive for the month. Does that momentum continue, Ron?
Well, I think the market is well positioned to continue to gain ground over the long term and the intermediate term. I think the Fed's decision this week to cut rates by 50 basis points was somewhat unexpected. Yes, priced by the market, but most economists, including and strategists, including myself, did not think they would actually go through with the 50. I'm glad that they did. I think they effectively bought an insurance policy against excessive weakening in the labor market. Now, you combine that with a strong corporate sector, a strong household sector, good corporate earnings. This is a market that can continue to work.
What are the biggest risks at this point, Ron, to that scenario?
Well, I think the biggest risk really are, number one, the election could change the trajectory of the economy depending on, which candidate wins, what the control of the Congress looks like, and whether they follow through on certain policies each of them have talked about. I do think longer term, one of the bigger issues most investors I talk to are worried about is just the magnitude and the expected expected length at which the U.S. is going to run large deficits. You can't continue to run a 6% of GDP deficit and expect not to have some consequences down the road.
Ron, I'm curious, we did hear from FedEx yesterday after close. Clearly they reported stock plunged today. Earnings season is going to be here before you know it. What are your expectations for corporate profit growth?
Well, I think you're going to continue to see a broadening out of corporate profit this year. It's interesting. For the last, I think, 6 quarters, if you looked at the S&P 500, basically all of the earnings growth has been from the big 6 tech stocks. And what we're seeing, though, is a gradual improvement from the other 494 stocks in the S&P 500. So when you look, for example, at the second quarter earnings season that we wrapped up about a month ago, the big 6 tech stocks had earnings gains of over 40%. The rest of the market only delivered about 5% earnings growth year on year. By the fourth quarter of this year, the consensus is that's going to narrow down to a 21% earnings growth for the big 6 tech stocks and 9 to 10% for the rest of the market. So I think you're going to see that broadening out, which to me is a healthier backdrop for an equity market rally as we move into 2025.
And indeed, to your point, I thought it was notable this week that we saw both the S&P 500 and the S&P equal weight making new records, which was really interesting. Does that mean as an investor, you want to be broadening as well where you are holding and really looking beyond big tech?
I think that is definitely the case. I mean, I'm not saying you should be shorting big tech or selling all your big tech, but on the margin, I think you want to be moving that next dollar of capital into other parts of the market. In particular, there's certain thematic areas you can look at. One is just the biggest one is companies that benefit from lower interest rates. If you look at the small cap index, the Russell 2000, it has about twice the debt to capitalization of the S&P 500. And also 45% of that debt is floating rate for small cap companies versus only 10% for large cap. So that's a real tangible example where companies will get an immediate benefit from the reduction of interest rates by the Fed. And given, obviously, that many of us are expecting the Fed to continue lowering rates, that should lift profitability as we move into 2025 for a whole raft of companies across the market. So I think, as investors, part one might be looking at things like small cap or moving down the capitalization spectrum. And then number two, I think, is looking beyond the immediate obvious winners from AI and all of the tech innovation we're seeing right now, and trying to identify the companies that are going to be able to profit from that innovation. So it's not going to just be 6 companies or a couple dozen companies globally that are going to win from this AI revolution. I think you're going to see significant opportunities across pretty much every sector, from healthcare all the way through to financial services and consumer stocks, where companies can put AI to work to reduce their cost, improve their profitability.
I'm curious, Ron, though, in that last earnings season, there was this dynamic of investors, it seemed like, starting to really push back on big tech spending on AI and raising questions about, where is the return on this investment? I'm just curious how you think that pushback plays out in the quarters ahead.
Well, that ROI conversation is one I've had with a lot of people in terms of how long can this juggernaut be sustained, right? The only way you can continue to see, A, the hyperscalers spending this much money, and B, other companies spending so much money on AI is if they start to see a return on investment. And if they don't, then the logical response is for the C-suite to basically say, hey, let's rein in that spending a little bit. And to the extent you start to see the revenue growth and the earnings growth decelerate materially, then that takes a lot of wind out of the sails of some of these tech stocks. Having said that, to the extent companies do start seeing an ROI, there's a chance they accelerate the spending. So again, I don't think it's a slam dunk that you want to be, running away or pulling capital en masse from these companies. I do think, though, it gets more and more challenging as we move through time if you don't start to see that ROI across the customer base.
Ron, thank you so much. Have a great weekend.
Thank you.